If you've been watching the financial markets lately, you know that volatility is the name of the game. Prices rise and prices fall, and it can feel like you're riding a roller coaster at times. But here's the good news. Volatility doesn't always have to be a bad thing. In fact, with the right strategy, market downturns and fluctuations can present incredible opportunities for savvy investors. Welcome to The Retirement Fix, a podcast offering strategies for less stress and more success in your go-go retirement years. I'm your host, John Gigliello, a certified financial planner with the Albany Financial Group, and I'm here to be your guide to keeping more of your hard-earned money by making smart financial decisions in retirement. This podcast is for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset protection. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Now, in today's episode, we're going to dive into a very timely topic: how to turn stock market volatility into opportunity. I'm going to share 7 ways you can potentially take advantage of a market downturn and make volatility work in your favor. While I want to touch on all 7 points, we will spend most of this episode talking about tax loss harvesting, a common strategy that may help you save money by lowering your tax bill. Since this strategy can offset ordinary income, taxpayers in high tax brackets and high tax states may benefit the most. Before I get into the details on these 7 strategies, I want to emphasize that I never encourage clients to try to time the market, but rather I urge most investors to stick with the long-term financial plan that we have designed to pursue their individual goals. Market volatility is built into each client's financial plan because we know it's going to happen, but we rarely know when. And even when taking advantage of market downturns in the ways that I am about to explain, it is crucial to not lose sight of the overall plan. With that said, let's dive in. Number 1, dollar cost averaging, or DCA for short. The idea behind dollar cost averaging is pretty simple. You invest a fixed amount of money at regular intervals, regardless of the market's performance. So when the market is down, you buy more shares for the same investment amount, which lowers your average cost per share over time. In volatile markets, dollar cost averaging allows you to remain invested without trying to time the market. By sticking to a regular schedule, you remove emotion from the equation. History has shown that long-term investors who use this strategy tend to benefit when markets recover. Number 2, buying on the dip. Next on our list is a classic strategy: buying the dip. When the market drops, some investors see it as an opportunity to buy stocks at a discount, giving you a chance to own shares at lower prices before they recover. But be cautious. The trick is to focus on quality stocks that you believe will weather the storm. It's not about speculating on short-term gains, but positioning yourself for long-term growth. Number 3, rebalancing your portfolio. During a downturn, you might notice that your portfolio gets out of balance. Some investments may have taken a hit, while others may have gained value. This is a great time to rebalance. Rebalancing involves adjusting your portfolio by buying or selling assets to ensure your investment allocation aligns with your risk tolerance and goals. If stocks have fallen, you may want to buy more shares to maintain the right balance. On the other hand, if certain investments have skyrocketed, it might be time to trim them back and reinvest in more undervalued areas. Rebalancing is a great way to take advantage of market fluctuations while staying on track with your long-term financial strategy. Number 4, look for dividend opportunities. Many companies continue to pay dividends even during a downturn, and some high-quality dividend stocks become more attractive when their prices drop. When the market is volatile, it may be a good time to focus on solid, dividend-paying stocks. Not only can you benefit from the income these dividends generate, but if the stock prices fall and you invest at a lower price, you will also enjoy higher yields on those dividends over time. Number 5, invest in defensive sectors. Market downturns often hit certain sectors harder than others, but some sectors are more defensive, meaning they tend to hold up better when the markets get shaky. These sectors include industries like utilities, consumer staples, and healthcare. Even during tough times, people still need to eat, pay for electricity, and take care of their health. These sectors are less sensitive to economic cycles, and investing in them can provide stability during market volatility. Number 6, consider buying bonds or other fixed income investments. When stock markets are down, many investors flock to safer assets, such as bonds, to diversify their portfolio. Bonds can provide steady returns in the form of interest payments, which can be particularly appealing when stock prices are fluctuating wildly. In fact, if interest rates are high or rising, bond prices may fall in the short term, creating an opportunity to buy bonds at a discount. When bond prices stabilize or rise again, you could stand to gain. Remember that there is an inverse relationship between interest rates and the value of a bond. When interest rates rise, the value of a bond falls, and vice versa. Finally, number 7, tax loss harvesting. Tax loss harvesting is a strategy we use often and the one I want to spend the most time on today. It's a complicated strategy with specific IRS rules to follow. In a nutshell, it involves intentionally selling securities for less than you paid for them. You then use the losses to offset taxable gains that you've realized in the same tax year. For example, say you bought a stock for $10,000. If the stock's value has declined to, say, $8,000, selling it results in a $2,000 realized capital loss. If you also have $2,500 in capital gains from another investment, applying the $2,000 loss from the stock reduces your taxable gain to only $500. Now, the maximum loss you can claim in a year is equal to your realized gains plus $3,000. The losses you take will offset your gains, and the excess $3,000 can reduce your taxable ordinary income. Any losses remaining can then be used in future tax years, and losses carried forward do not expire. By reducing taxes owed in the current year and allowing excess losses to be carried forward, tax loss harvesting enhances your ability to reinvest and compound returns over time. Lower tax payments free up additional capital that can be deployed into new investments, potentially increasing overall portfolio growth. Minimizing the tax drag can significantly improve after-tax returns in long-term investment plans. Using this strategy can be tricky, however, as the IRS has set rules for its use. For one, you cannot repurchase the same security within 30 days of selling it at a loss. If you do, the IRS will not permit you to claim that loss on your tax return. This is known as the wash sale rule, and we'll talk more about that shortly. The first step of tax loss harvesting is to review your portfolio and add up the taxable gains expected that year. If you have $3,000 in gains, you could use up to $6,000 in losses, assuming you earned at least $3,000 in ordinary income the same year. The wash sale rule sounds simple at first. Do not repurchase a security you have sold if you intend to deduct the loss, but there are important considerations. Your spouse's trading activity counts as well. If you sell the security and your spouse repurchases it, that loss cannot be deducted. Also, the window is 30 days before or after the trade. The wash sale rules considers purchases made before and after the loss is realized. Purchasing substantially identical securities will indeed trigger the wash sale rule. If you want to deduct a loss on, say, an S&P 500 index fund, you cannot purchase a different S&P 500 index fund within the restricted window. The wash sale rule also covers all of your accounts. You can't sell an asset at a loss in a taxable account and then purchase that same security or substantially an identical one in your retirement account. There are risks involved too. Selling assets may change the overall risk associated with your portfolio and your expected returns, and those changes can impact your ability to reach your financial goals. Again, this is where your long-term financial plan comes into play. When selling at a loss, you'll want to review all available tax lots on each fund. A tax lot is a single transaction of shares purchased. Each lot can have an unrealized gain or loss, which could be different from your net position on the same security. To demonstrate, let's assume you have spent $1,125 purchasing 100 shares of ABC stock over 4 transactions. If ABC is trading at $13, you have a net unrealized gain of $175. However, when you review your purchases of ABC, you see that one lot is in a loss position. 1.25 shares at $10 each, 2.25 shares at $15 each, 3.25 shares at $8 each, and 4.25 shares at $12 each. Because tax law allows you to specify which shares you are selling, you could liquidate 25 shares from the second tax lot to create a loss. Now, you also need to consider whether capital gains are short-term or long-term, as the two have different tax rates. Short-term capital gains are realized by selling investments you owned for 1 year or less. These gains are taxed as ordinary income at your marginal tax rate. For this tax year, 2025, the highest marginal tax rate is 37%. Long-term capital gains arise on securities you own for longer than 1 year and are subject to potentially lower tax rates. Your tax liability on long-term capital gains is either 0%, 15%, or the highest at 20%, depending on your income. Because of the higher tax rate on short-term gains, it's more efficient to offset a short-term capital gain with a short-term capital loss than to create a capital loss to offset a long-term capital gain. Since you can offset gains this year with older losses, consider whether you have any unused losses available before incurring new losses. If you have losses and no gains this year, you may benefit more from saving the losses to use later. Carrying forward the losses may be wise if your income is low today and you expect to realize larger capital gains in the future. If your financial plan involves a large liquidation down the road, maybe to buy a house or fund your child's college education, you may become subject to the highest capital gains bracket of 20% in that particular year. Carrying forward losses from lower income years, in that scenario, could allow you to offset a 20% tax liability later. Tax loss harvesting does have its limitations, and there are a few things you should be aware of. Transaction costs, for one. Frequent buying and selling of securities may lead to increased transaction costs, brokerage fees, commissions, and fund expenses, reducing the overall benefit of the strategy. You should carefully evaluate the impact of these costs to ensure that the tax savings from harvesting losses outweigh the expenses incurred through increased trading activity. Consider the complexity of tracking. Tax loss harvesting requires diligent tracking of cost basis, transaction dates, and realized gains and losses while being mindful of the wash sale rule. Keeping track of these restrictions across multiple accounts, including taxable brokerage accounts and retirement accounts, can be challenging. There's also a potential for missing future gains. Selling a security in a market downturn locks in the loss, meaning a realized loss. So you may not benefit from a potential recovery in the price. If you replace the asset with a different security that does not perform as well, the long-term growth potential of the portfolio may be negatively impacted. Also, attempting to time the market based on short-term losses may lead you to make decisions that are counterproductive to your overall investment strategy. While tax loss harvesting provides tax benefits, it should not override fundamental investment principles such as long-term growth, diversification, and maintaining an appropriate balance between your risk tolerance and capacity. And it may not be suitable for all investors. Tax loss harvesting is primarily beneficial for investors with taxable accounts, as tax-advantaged accounts such as IRAs and 401ks do not incur capital gains taxes. For investors who hold most of their assets in tax-deferred or tax-exempt accounts, the benefits of tax loss harvesting are indeed limited. Tax loss harvesting is complicated, and there's always potentials for errors. I always encourage you to work closely with your tax and financial advisors to make sure any strategies you employ aligns with your long-term goals. The bottom line is, if done correctly, tax loss harvesting can lower your tax bill now and increase your wealth later. Remember, the stock market is a long-term game, and volatility is just part of the process. By staying patient, using smart strategies, and doing your research, you can turn a volatile market into a powerful opportunity for growth. One of the services I offer high net worth retirees is proactive tax planning. We review the anticipated income from all sources each year and employ strategies to help clients make the most of their hard-earned money. If this sounds like something from which you might benefit, please reach out to us. You can find more about the services we offer at www.jgigliello.com. And don't forget, we always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand that the success of your retirement is too important to be managing yourself, and you value experience and professional guidance, feel free to give us a call for a complimentary initial consultation. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you found this helpful, please share this podcast, and don't forget to subscribe. If there's a financial planning topic you would like us to address on a future episode of The Retirement Fix, please reach out to us and let us know. Thank you all for listening, and make it a great day. Material for this episode was derived from 2 Forbes articles on the subject. How Tax Loss Harvesting Works, February 26, 2025, and 8 top tax loss harvesting tips to reduce your tax bill, November 13, 2024. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation.